going to look at the fourth chapter, that is business services. So in this chapter we will be looking about the characteristics of services, then types of business services, then what is the e-banking. Such topics we will be covering in this chapter. So moving on to the first part, for the introduction. Services are those separately identifiable, essentially intangible activities that provide satisfaction of wants which are not necessarily linked to the sale of product or another services. That means services are those separately identifiable. They are not like goods. Goods are physical form. We can see what the type of product is, what they are selling. But in the case of service, it is an intangible activity. That is, we won't be able to touch. We can only experience the result. So these are services provided for satisfying the needs, but which is in a form of experience. It is not in the form of a product. But when it comes to goods is a physical product. We are able to touch, we can see what the product is, and it involves transfer of ownership from seller to customer. So that is, from one person it has been transferred to the next person. For example, if you take a car, if you sell a car, it the person on whose name this car will be registered is the owner of the car. So it's the ownership is transferred to the person who is buying it. We are going to look at the nature of services. The first one is intangibility. Intangibility means that we cannot be touched. We can only experience what the result is. For example, a doctor's treatment, we can get the final result in the form of experience, right? But not in the form of a product. The second one is inconsistency. The inconsistency means that different customers will experience the services in different way, not in the same ways, because according to the needs and wants of the customer, the services are provided differently. So it is not consistent. It is not in the same way that everyone will be experiencing it. The third one is inseparability. Inseparability means that, for example, when you manufacture a car today, you can sell it afterwards, because like after a month or two. But if when you are dealing with services and the customer demands, you will have to provide it at the same time. There is no separate. We cannot separate it. So it means that services providers may design a substitute for the person by using appropriate technology, but the interaction with the customer remains a key feature of services. So in this, it mainly means that nothing but it cannot be separated, because it have to be done at the same time when it is being asked for. The fourth one is inventory. It means like services have little or no tangible components. It is not like a product, so we cannot store it. If it is a car or if it is an electronic gadget, we can store it. But services is not dealing with products, but in the form of results. So then it cannot be stored for a future. So there is no inventory. Then the fifth one is involvement. Involvement means that a customer has the opportunity to get the services modified according to the specified requirement. This means that a customer's needs differ. Each individual's need differ, so it is modified according to that. So customer's involvement is also taking place in a service. Next, we are going to look at the types of service. First one is business service. Business service are nothing but the activity services done for growth of the business. That it can be like, examples are banking, insurance, transportation, warehouse, communication, etc. The second one is social services. Social services is nothing but these are mainly done to improve the society, like improving the standard of the society, then bringing up the weaker section, then providing educational services, health facilities. All these are done to benefit the society. So this type of services are known as social services. Third one is personal services. Personal services means how each individual experience the service, because we said that different persons will be experiencing it in different forms. For example, you can take tourism, restaurant. So if when you go to a restaurant, if 5 persons are there, 5 persons will be ordering, if they are ordering the same food, but 5 will be experiencing the taste differently, because some will like it, some will not like it. So it is a personal. Like that also tourism, they will be exploring the nature, exploring the tourist places differently. Each will have their own views. Next is business services. So we said that business services are service done for the growth of business, like banking, insurance, telecommunication, transportation. So we are looking at what are the business services, types of business services. First one is banking. Banking is nothing but it means it's a business in which accepting for the purpose of lending and deposit of money from the public, repayable on demand, otherwise withdrawn by check, draft or otherwise. That means the main function of bank is they lend money to the people and they also accept deposit. While they lend money to the people, they will be given a repayment period of 1 year in installments, in the monthly. They will have to repay, either it can be in the way of check, in the way of draft, or some other tools can be used. So the main intention is lending money to the public and then accepting deposit from the public. We are going to look at types of banks. The first one is commercial bank. Commercial banks means it is being regulated by the Banking Regulation Act 1949. And the main purpose is accepting deposit from deposit of money for the purpose of lending or investment. So there are two types of commercial bank. The first one can be public sector and the second one can be private sector. If it is a public sector bank, then the government has a major role. And if it is a private sector, then are controlled and managed by private parties. For example, you can see that SBI, PNB, HDFC Bank, ICICI, Kotak Mahindra. So are examples of private then public banks. Second one is cooperative banks. These banks are governed by the provision of State Cooperative Societies Act. This act is came upon on the provisions of State Cooperative Act, and they are meant for providing cheap credit to their members. If it is a farmers corporation, then they for providing credit among themselves, they create such groups and they can avail loan from cooperative banks. Can be rural credit, agriculture financing. The third one is specialized banks. Specialized banks are foreign exchange bank, industrial bank, development bank, export import bank. Mainly they add to the economic growth, and these can provide financial aid to industries, heavy projects, foreign trade. These are the activities coming in other specialized banks. Next is central bank. The central bank of the country is the main who supervises, controls the activities of all the commercial banks of that country. So all the commercial banks are being headed by the central bank. So, India, the central bank is named as Reserve Bank of India. This is the central bank of India. We are going to look at what are the functions of commercial banks. First one, as in the case of every bank's, first one is acceptance of deposit. That they accept deposit from the public. We people deposit some money in the bank, right? So that is the deposit which we are giving to the banks. They accept it. That is what is meant by acceptance of deposit. The second one is lending of funds. Lending of funds means when we want loan, we want to avail loan, we go to the bank and we ask them for, by providing documents, we ask for funds. So that is, they provide us funds. That is lending of funds. And third one is check facility. That is, check facility means if you want some cash and somebody has given us the form of check, then we go to the bank and change this check and take the cash. So this is what the check facility has been given by a bank. They're collecting their checks drawn on the other banks. Then the fourth one is remittance of funds. Another important which is another salary functions of function is of commercial banks providing facility of fund transfer from one place to another account of interconnectivity of branches. Like if you want to transfer some money to somebody else through the bank, we can do it. We can ask them to transfer fund to the person. We can give the account number of the other person and we can transfer. So that is what is known as remittance of funds. Then it is allied service. Allied service means services other than accepting and depositing, like it can be bill payment. The payment of our bills can be done by the bank, and we have to give them some service charge, like locker facilities. We give gold money inside the locker, for that they charge us service charge for giving the locker. Underwriting services, then buying and selling of shares. So these are allied services, that is the services other than the main two services, that is accepting of deposit and lending of money. Now you're going to look at e-banking. E-banking is nothing but it is the electronic form of banking. That is, now the world has changed everything into the online world. So the businesses are being carrying out online. So this is what is known as e-banking. So it is nothing but, in simple terms, you can say internet banking means any user with a PC and a browser can get connected to the bank's website to perform any of the virtual banking function, avail any of the bank services. For example, the greatest example is Google Pay, where you're using it, you're transferring fund, you're depositing money, or withdrawing cash. So all this is taking place, but you just need a laptop, you just need an Android phone or a browser. That is just enough. So this is what is meant by e-banking. Now going to the benefits of e-banking. E-banking facilitates digital payments and promotes transparency in financial. Digital means through online. Then it can be 24 hours, 365 days it provides its services. Then it can be means it can be done through a mobile telephone. While traveling it is not necessary for us to go and visit a bank. Then it includes recording of transaction. Then it also includes greater customer satisfaction, because unlimited access to bank is possible, right? Because after 4 o'clock also we are able to withdraw money, deposit money. Why? Because we are having online facility, but you don't need to go to the bank physically. Now we are going to the second service. First one was banking, the second service is insurance. Insurance. Life is full of uncertainties. Yes, there are many risks. Uncertainty here means risk. So the chance of occurrence of an event causing losses are certain. When a business activity is taking place, many loss can happen. It can be theft, it can be fire, or some natural calamities, or all affect our business. So for lowering the risk, so for a protection, we take insurance. So we can define insurance as: insurance is a device by which the loss likely to be caused by an uncertain event is spread over a number of persons who are exposed to it, who are prepared to insure themselves against such an event. So it means that we are insuring against the loss which is going to occur in the future. So for a protection, we are taking insurance. So it is a contract. One party agrees in return for consideration to pay an agreed amount of money to another party to make a loss, damage, or injury. That is, when a loss, damage, or injury takes place, this one party agrees to other that you will get certain sum of money when this loss occurs, so that you have to pay some premium amount monthly. We're going to look at the functions of insurance. Coming to the function, the first one is providing certainty. That is, we are sure, while insuring, we are sure that we will get some payment for the loss. That is, we are able to protect, and we will not be getting the whole amount of loss which is caused. We will only get a portion. So there is certainty that we will get at least a minimum amount. Second one is protection. Protection means the main function of it's the protection of chances of loss, protection from chances of loss. That is, to protect us from the loss which is going to be occurring in the future. Third one is risk sharing. Loss is shared by all persons exposed to it. When a loss is occur, not only if you want two or three persons will be bearing the loss, all the members of the business, all the partners of the business will equally share it. Assist in capital formation. The accumulated funds of the insurer received by way of premium payments made by the insurer invested in various income generating schemes. That is, the premium which they receive from the insurance company, they can be invested in various sources to generate more income. They can invest in shares, in some trading activities, and they can get more income. Then we are going to look at the principles of insurance. What is the principles of insurance? What are the rules? The first one is utmost good faith. Both the insurer and the insured should display good faith towards each other regard to the contract. That is, when you are taking an insurance policy, both must be that the insurance company and the insurer, both the parties must be having a good faith. It should be honest. So it is the duty of the insured to voluntarily make good full accurate disclosure of all facts material to the risk being posed, and the insurer to make clear all the terms and conditions in the insurance contract. So the insurance and the insurer, they must disclose all the facts and contents, and they must be honest in doing their activity. The second one is insurable interest. Insurable interest means that the party who has taken an insurance policy must have an interest in the subject matter. So when you have interest only, you will take insurance policy, right? There must be a reasonable interest in the subject matter. That is, insurable interest means some interest in the subject matter of the insurance contract. The third one is indemnity. Indemnity means that insurance contracts of fire or marine insurance are contracts of indemnity. According to the insurer undertakes to put the insured in the event of loss the same position that he occupied immediately before happening of the event insured against. Or other words, you can say that insurer undertakes to compensate the insured for loss caused to him due to damage or destruction of property insured. That is, the insurance company will is a promise that they give that when a loss occurs, they will what they will do, they will compensate for the loss which have occurred. Next is proximate clause. According to this principle, insurance policy is designed to provide compensation only for such loss that are caused by the perils which are stated in the policy. That is, if a fire is happening place, we cannot say that a fire has been caused if somebody has intentionally put fire to the goods. So if they can identify that, the company, they will check, and if it is a major cause, then only they will provide the insurance policy. Simply they will not give. Some business organization do like that. They themselves put fire to the properties and they will claim for insurance. So if some otherwise even two damages take place, two loss take place, they will look which loss is major one, and they will give compensation for the major cause. And fifth one is subrogation. It means the right of the insured to stand in the place of the insured after settlement of claim as far as the right of insured respect or recovery from alternative sources involved. That is, the insurance company must stand in the place of the person who has taken the policy, and they have to settle the claim. Then or they have to give from alternative sources. They should give the compensation. Then only they should move. They should act on behalf of, and they should protect the insured person who has taken the policy. So they should, what they should do, they should stand in the place of the insured after settlement of a claim. Next is contribution. As per the principle, it is the right of an insured who has paid claim under insurance to call upon other liable insurance to contribute for the loss of payment. That is, so it is the right of the insurance. So who if he has paid the claim under an insurance, he can call other insurers to contribute for the loss of payment. Next is mitigation. This principle states that it is duty of the insured to take reasonable steps to minimize the loss or damage to the insured property. That is, the insured who has taken the policy, he should always take steps to minimize the loss. He should not take steps to increase the loss. Always take steps to decrease the loss. So he should be very careful in storing goods, so they should not easily catch fire or damage. So he should always be careful in handling his properties. Now we are going to look at the type of insurance. The first one is life insurance. As we all know, the person's life has uncertainty that he can die anytime. It is not in our hands. So we can insure our life. So since life itself is uncertain, all individuals try to assure themselves certain sum of money in the future, take care of unforeseen events. Individual in the course of their life always exposed to some kind of risk. As individual we can have financial problem, or it can be death, it can be whatever problem it is, we insure our life so that we will receive it after the end of certain period or after the death of a person. So this type of insurance is known as life insurance. So we can define insurance may be defined as a contract in which the insurer in consideration of certain premium, either lump sum of other periodical payments, agreed to pay to the assured or the person for whose benefit the policy is taken, the assured sum of money happening of the event contingent on the human life or the expiry of certain period. That's what it said. If in case of a life is insured, then what happens is he has to pay claim every month, and after a certain period he will receive the money back, or when a death occurs, then he will receive the money. Whichever happens first, they will receive the money. Now we can look at the types of life insurance policy. The first one is whole life policy, that is for the whole life. In this kind of policy, the amount payable to the insured will not be paid before the death of the assured. That is, this whole life policy is for the entire life, so only after the death you will be receiving the policy amount, so it cannot be paid before the death of the person. Second one is endowment life assurance. The assured undertakes to pay a specified sum when the insured attains a particular age or on his death, whichever is earlier. So here the age and death, in these two, whichever happens earlier, then the policy will be paid. We will get money from the insurance company. Then joint life policy. This is taken by two or more persons. This insurance policy is taken by two or more persons, and the assured sum of policy is payable upon the death of any one of the person to the survivor. If husband and wife together has taken the policy, then after the death of if husband dies, then the policy will be given to wife, or if the wife dies, the policy will be given to the husband. So it is jointly taken.